disappointing about this is that, we have this innate fight or flight in as a human, and they're taking advantage of it right now. So I thought this would be very, very important to run this class. So I want to start off just by going through the economic timeline that I went through. If you hadn't caught some of the other classes, what I had explained is that my background is 35 years plus. Now I'm going on 36. I guess this will be the 36 years. In July, I'll be 37, I guess. And I have been through a lot of these major crashes. Back in 1987, I worked for a large firm. And in that firm, I told everybody last week, I think it was, that, when that crash happened, I'd watched the institutional guys over there, and they were licking their chops. They were smiling. Everybody else was afraid. These guys were smiling. They were excited. Why? They were playing against everybody else. But I also got to watch what they did in this institution. They did what's called economic mapping. And they put all the events, they put the GDP, they put the unemployment, they mapped it all out, and then they created different variables as to what they believed that the market was going to do versus and real estate and unemployment, et cetera, et cetera. And it was interesting to watch what they mapped out came about 80% true. So back in 2001, actually in 1996, I had left that firm in 1991, I think it was, and I hung my own shingle, and there it was, right in 1996, we had this giant bond market crash. And so what I did was, what I learned and watched other people do is economic mapped it out. And then again in 1999. And in 1999, I had a radio show. And so what I'm telling you here can be proven by everything that I did on a radio show for 10 years. 1999, got on the radio show over and over again. I said, get out of the market, get out, get out, get out. This is ridiculous. And I remember watching these shows on TV. I'd come home at night and I would turn on CNBC or whatever it was back then. And I remember watching this panel of people, and they had become day traders. Now, you may not remember this, but there was actually storefronts that would open up that would offer high-powered computers. And these people were leaving their jobs to become day traders. Now, if there was ever a repeat of the 1929, why the 1929 crash happened, this was it. You had false trading going on where there was no intrinsic value in the trading. And these people were leaving their jobs. Why? Well, they show up and they make $20,000 today and $20,000 tomorrow because everything was just going up. It was the tech age. I'll never forget watching that. And somebody came on CNBC and they were being interviewed. Yes, I left my job to become a day trader, and they showed them in this little storefront. It was like a little Subway or a little, hair cutting place in a little strip plaza. There's all these guys lined up and they're just sitting there day trading. And I thought, this is the most insane thing. This is literally the 1949 gold rush. This is these people thinking that they're going to make their wealth. They leave everything. And, the bottom line was in 1849, the gold rush, the fact of the matter was the average gold prospector made absolutely nothing. They left in poverty. You know who made money in the 1849 gold rush? That's right. Everybody who sold supplies to the miners. They sold the tin pans, they sold the picks, they sold the axes, they sold the shovels, they sold all the sifting material. That's who made the big, big money. They stepped back and said, that's an insane way to try to make money. And then I saw that again. I said, these are the things that we have to learn from history. And so what ended up happening was, most of you know, the tech market crashed about 75% in 1999, and it took 15 years to recover. Now, I wasn't surprised. And the reason is anytime you trade something up 100 to 1 on its intrinsic value, 400 to 1 on its intrinsic value, yes, it's going to crash hard, very, very hard. Then what happened was the 2001 terrorist attack happened. And again, while we got out of shock after the first day, what I did was went back and economic mapped it out. Now, when I economic mapped that out, I was about 80% accurate. I wasn't 100% accurate. What I mean by accurate was I didn't predict when the market would peak or be at its bottom. What I mapped out is what I learned to map both economically along with human psychology, and how long certain things take to come out of that depression. And again, if you're buying things at 400 to 1, yeah, it's going to take 15 to 25 years. We've learned that over. But in this crash, we don't have that type of situation. We don't have things that were trading unrealistically. We had a very solid financial system going, and there were certain stocks that were still in the 18, 19, and blue chip stocks in the 18, 19, 20 on the PE ratio. So it wasn't insanity. This is an event much like 2001. Then what happened in 2007, 2008? Again, in 2005, 2006, I was on that radio show, so I'm not making this up. You can go back and go online, look up the archives, you can listen to it. And I said, this is insane. This market will never, ever continue like this because you have the price to rent ratio that's at 4 times its norm. That's back when, they were giving mortgages to people that were $1 million mortgage and they were making $30,000, but they were lying on the application and there was no document verification needed. And I said, this is the most insane thing I've ever seen. And sure enough, it crashed. And as soon as it crashed, then what we did is we economically mapped it out. That mapping was, again, about 80% accurate. Now, while I can't sit here and tell you that I'm going to be accurate with this mapping, I can show you exactly how I'm thinking that this is going to play out in the next 12 to 24 months. Once you understand this mapping, it'll give you a basis. Now, you may vary it. You might change some of the dates. You might change some of the events, and that's up to you. That's how this works. It's your opinion on, just like my opinion, it's your opinion on how this might play out. And this way, it'll give you a basis to understand why you should be aware. And what I mean is beware or be aware of what's happening within the annuity markets, because I know some of you have come to me and said, hey, this guy came to me and he promised me this and he promised me that. And should I do that in the down market? And let me explain one thing. You don't do anything irrational in a down market. You step back, like any emergency, you work the problem. You work the problem because this way it'll give you a logical mathematical outcome and then you can make better decisions. So let me show you what I foresee coming down the pipe. And it's about a 3-year layout. Now, if you look down on the grid on the bottom right-hand side, you'll see the green is birth rate, the orange is real estate, the yellow is employment, the blue is stock market, and the biggest one, and this is where I see the biggest, what would I say, the beware of, or you have to be very careful of in how you do your planning. And I'm going to throw in what we just found out about required minimum distributions, about loans against IRAs, and some of the changes within the Secure Act that will make this tax issue that I'm foreseeing is going to be even a bigger issue. Okay, so let's start working on mapping this out, and then I'll integrate that in with the annuity discussion so you can see exactly, if you already have an annuity, how you play that. If somebody's proposing an annuity to you, how you play that. Okay, so let's go back to where this virus started to come alive. And we know that we as a country, because of misinformation from China, had a lot of disbelief. We saw some kind of market fluctuations back in January, but we just didn't have the belief because we were led to believe something very different from China. And as you probably have already read, they refused the CDC. They kicked out our reporters. And since, they couldn't take our reporters, they took their reporters and basically squashed any kind of true information coming out of China. But what happened is our institutions work on millions and millions of dollars of what's called big data. They crunch these numbers, they start running models, and they are ahead of you, the person that's watching CNBC, MSNBC, or Fox News. These institutions, whether it's a hedge fund, pension fund, mutual fund, they're already predicting trends and what's going to happen. That's what their job is. So they start selling. Well, then what happens is consumer fear steps in because you as the consumer start going, oh my gosh, the market is going down. And again, the institutions know this. They're literally measuring. And now it's gotten to the point where they're not just measuring trends in world data. What they're actually measuring is social posts. They're measuring by artificial intelligence on what the sentiment of the consumer is, even picking up messages on I'm getting out, I'm selling, I'm going to cash. This is exactly what they're looking to do. And as that happens, we start to see this fallout, the market starts to drop. Now we've got this quarantine. This is what's very different from 2008. Now we've got this quarantine, so people start losing their jobs, cities start shutting down, and along the way, real estate freezes. I had watched something the other day, and the guy said, I'm expecting the biggest real estate boom in 3 months. Again, what you see a lot on TV, understand that they might be hedging against it. So if what you're doing is you're taking that advice and you're saying, well, I better buy in right now. So what they're doing is working the opposite side of the buy or sell because they want to hedge against whatever you are doing. So I always tell people, be very careful what you hear. Map it out, take the logic of it. Don't just listen to somebody that's on TV going, this is what it is, especially if they're managing money against you. And just about every institution is. So real estate flattens out. Why does real estate flatten out? Well, today, Cheesecake Factory and Subway both said that they can't make their rent. We know that there's a 12-month freeze on foreclosures and evictions. How do you think that the mortgage companies are going to pay that? All this debt will accumulate for those people that are trying to get their jobs back or trying to go back to work. Okay, so what's going to happen is that real estate's going to freeze, and then it's slowly going to decline because those people that either need to or want to get rid of their homes are going to have to start to lower the price. Some people oppose that and say, well, the mortgage interest rates have dropped. That's true. It has. However, if you have this major unemployment rate, 3.8 million people just claimed unemployment, and it's going to increase every week. I don't care if the mortgage rates are low or not. There's going to be what I call crowding, which is what happened in bunching, which is what happened in 2008. So when people start to lose their jobs, they start to cluster together inside of apartments and houses. And maybe instead of having, a single person inside of an apartment, now there's 4 people sleeping on couches, and that leaves 2 or 3 apartments empty. Okay, so this is what we have seen. We've learned from this. We can now map this out because this is what humans do. They say, I can't afford that apartment, so I got to find somebody to live with. That is going to have a much slower burn. Remember, real estate is always about 6 to 9 months behind what the stock market does. Now, as the consumers continue to sell, we are going to reach this point where we see viruses level. We already start to see the social distancing, which is working. In South Dakota, they have very few cases because of the social distancing that they are putting into place and had put into place prior to any shutdown. However, in certain places where they're not following the social distancing, we see this great increase in the virus. However, we also know now that there's a lot of places that have self-contained it, that have followed certain trajectory based upon other countries like South Korea, et cetera. So when we start to see these virus levels level out, and they have not leveled out, we're going to lose a lot of the volatility that we're seeing right now in the stock market. Businesses will reopen. Along the way where you see this blue line, which is the stock market, understand this is not a straight downward trend. We saw the biggest week in the stock market. It's an uptrend. Expect a lot more volatility. Expect to see 5 to 8% volatility on a daily basis because, again, it's not necessarily that it is the consumer that is selling out. These are the large institutions that are playing against your psychology. So in other words, when the market goes up, everybody has a fear of missing out. Wow, I could make a 30, 40%. Let me get in. Let me get in right now. They get in. Institutions know that. They're following social media. They're following the trends. There's now even a big data company that can tell you, based upon your mobile phone usage or your mobile phone, what is the distance that you traveled? So they can actually now measure who and where is social distancing actually happening. So let me tell you, these big institutions are buying this data and they're using it to trade against you. So don't believe just because the market goes up 3 days in a row that it's not going to come right back down again. I don't think it'll go back down to its original 18,000 on the Dow, but it's going to see a lot of volatility. That will work itself out. As the businesses start to reopen, and now that we've got this multi-trillion dollars, up to $6 trillion between the feds and ancillary, the SBA, Congress, there's a lot of money that's going to be thrown into the system. As that starts to happen, businesses start to open up, people will become employed again. As people become employed again, there's going to be a spending spree. We saw this in 2001. We saw it again in 2008. We've been cooped up now. We've been cooped up now for about 3 weeks. And, I can't wait until I can get back out and just go out to dinner with my family or go see a movie. And we're going to see this across the country. And we're going to see this huge surge in spending. This will give a false positive reading. We're going to think that it's all over and everything is going up. Keep in mind, these institutions are watching this. People will buy back into stock again. They think it's all good. Institutions will then trade against you, pushing that stock market back down again. Now, as these businesses continue to open and we get to see some of these profit takers start to level out, then the stock market will have a much less volatility. However, because real estate always follows the market 6 to 9 months, we're going to see many, many more foreclosures. Even though the stock market might still be going up, we're going to see a lot of foreclosures. And this is what I want to prepare you with today with the discussion on annuities. And some of the estimates, and I've modeled out some of these estimates, and my guesstimate is somewhere between 20 to 25% with a high end of 30% on the foreclosure rate. Now, the government can come in at a later time and bail that out, but it doesn't preclude you from finding some really great deals in the real estate market. Okay. Now, what will also happen is when this market, the real estate market, gets down to a low, you're going to have institutional real estate investors come in. There are major institutions that buy commercial, retail, land, and even single-family homes, and they buy them in the billions of dollars. So what happens is when that market just dumps, that's what they're waiting for. They're waiting for that foreclosure rate to peak out so that they can go in and buy this stuff at pennies on the dollar. This is what you want to follow, that same trend. It's much easier to follow the real estate trend than it is the stock market trend because there's too much big data behind that behind the stock market, and it's day-to-day emotion. What I mean by that is a lot of times people will log in on their stock account and they'll make an immediate transaction because they can just push a button. The advantage of real estate is it removes a lot of the emotion and irrationality because you can't just log into Zillow and say, oh my gosh, my house just lost $200,000. Sell it like you can with a stock. So it's a much slower volatility and slow burn or slow grow. So as the employment starts to increase, we have the employment go up, but what's also going to happen is just what we saw in 2001. We had this major birth rate spike not too far after the terrorist attack. And why that's important is because when we talk about consumption, Warren Buffett says it's the best. The number one thing that you can follow to determine whether stocks will go up in a year or two is the birth rate because consumption goes up. So we have a birth rate increase potential here. That continues to increase the stock market at the same time. Now, real estate is going to go back and surge. However, here's where we have to be prepared, and this is why I want to show you what to do with these annuities. So now we're going to have this major, major tax problem. And we're already seeing it now with the Secure Act where they're going after people with IRAs. And they've gotten rid of the stretch IRA provision. But we're going to see this major increase in taxes that everybody has to prepare for. Now, here's the addition. Because I got a lot of questions last time on where do you see the volatility? Well, in that new line that you see in front of you, that new box, in this area is where I see the highest amount of volatility. And that volatility will last from right now until November, December. You may even see some of these large hedge funds and institutions play some of their games at the end of the year and then take the money off the table and then show some paper losses for themselves before the end of the year and catch everybody by surprise because sometimes they will do that. But you can expect there's going to be a lot of volatility. Now, during this period of time is where you can capitalize. This is the time to actually take advantage of it. So let's jump into the annuities. All right, so what is the types of annuities? Well, you have fixed annuities. They're more like a CD. And really, I think a lot of the confusion comes into, well, what kind of an annuity is out there? Well, there's equity indexed annuities and there's variable annuities. So I want to be very clear. Today, I am not talking about variable annuities, and I'll be very blunt. I don't like them. I so dislike them. I think that they were conjured up in a collusion between the insurance companies and the mutual fund companies. And usually when we measure these things, you're talking expenses in the 3.5 to 4.5. We'd even see 5.5%. And I'm sorry, 5% for an investment, I don't care what it guarantees me. I have virtually no capacity to make money on that thing. So I do not recommend, or would ever suggest a variable annuity. And what's amazing is I get arguments every time I do a public venue, and I argue against variable annuities. And of course, you get the brokers, the the wirehouse guys, the bankers, and they always send me these things. How dare you talk about variable annuities? They're great because I have a lifetime guaranteed rider. Right. Okay. So I'm going to pay 4 to 5% to guarantee my income. I could go buy a government bond and, a 30-year bond and probably get 3.5 to 4% interest right now and still have a guaranteed income that's probably a lot more secure than an insurance company. And so, I'd still have to make 8 to 9% after your 4 to 5% fee to beat what the government bond would pay. So again, today's discussion really is about equity index annuities, not about variable annuities. I could talk all night about how much I dislike these things. So today it's more about beware and be aware of the times. Now, look, if you are in a time where the market is at a very low end and we can anticipate that the real estate is at a very low end, when is the last time that you want to buy an annuity when everything is down? And one of the reasons is, and you'll see this in a second, is because of what we call the one-day market time on an annuity. So in down times, people generally look for things that are safe, gold and REITs promised by salespeople to make 5 and 6% dividends, which, by the way, is one of the biggest Ponzi schemes I've ever seen. So gold, cash, annuities, private REITs based on dividends. Look, companies know how to capitalize on this fear. I'm telling you just the opposite. Now is not the time to be afraid. Here's when the time to be afraid is. Just like what I said. In 1999, when the average tech stock was trading at 300 PE ratio, that's the time to be afraid. Not now. When is the time to be afraid? In 2008, when you look and you say, this is insane when a $30,000 a year earner can buy a $700,000 or $800,000 house. That's the time to be afraid. When you have things that are now trading at 14 and 15 PE, this is the time to get excited and not be afraid. Do not run for the hills. It's the time to actually take advantage of these things. So, companies will use their advertising power and they will get people to buy these things. Right now I'm at home, so while I'm working, I've got, the financial stations on every single day. Every other commercial is buy gold. You won't lose money. And I love how the one guy gets on there and says, now, if you would have bought gold in 2005, by 2012, you would have multiplied your money times 4 times. Yeah, buddy, anybody can pick any perfect date and time to start that analysis, right? So here's what I could do. I'm going to tell you that I can make you 45 to 50% rate of return on your money. And all I had to do is pick 9/12 of 2001. Well, it'd be a giant lie, wouldn't it? Because I'm picking the lowest period of time to calculate when I'm computing my rate of returns. So do not believe these things that you see on TV. Had you bought this, you would have made X number of percent. Or the other commercial is, all I got to do is with my gold is sit back and it makes money for me every day. Okay, so how do you sell the gold? What if there's a cash shortage? Who's going to give you the cash for that gold? Gold, just like Warren Buffett says, gold does not earn a dividend. It does not make money. It does not have an income that can actually give it an intrinsic value. And how gold is valued? Fear. Fear and greed. That's all it is. Supply and demand, fear and greed. You're not buying a business. Buy a business. Because you can now say, hey, this has got a third. I want to buy Johnson & Johnson. I want to buy Pfizer. Why? Because they're producing pharmaceuticals. I'm not recommending you go out and buy that. I'm saying if I want to buy a business, I want to buy something that I can analyze, rip it apart, find out who's managing it. What are their sales? What are their cash flows? What are their debts? So that I can analyze whether it's something that I want to put my money into because I believe in that kind of business, right? Now, would you want to put your money into Betamax? No, not when there's 5 other competitors out there that would have destroyed it. Do you want to put your money into something that is going to be obsolete very soon? And there's a lot of businesses now with this big crash that will become obsolete. So look at the perceived crisis products, right? What are these things? They're annuities, they're REITs, and they are gold. Well, again, now is not the time to go to the fight or flight of the human emotion, right? So let's talk about fixed annuities. What is the real goal of a fixed annuity? Now, when I say fixed annuity, I am referring to a fixed index annuity. The goal is, why somebody would buy this is there's no loss during market downturns. There's a guaranteed income for life. This is how they sell them. ability to participate in the upside of the market with the potential for no market loss. Again, that's not a variable annuity because you will take market loss with a variable annuity. So here's the annuity basics. Now, the reason I am going through this, and you might be looking at this and going, wow, gosh, I think I'd rather watch like hair grow or paint dry because I don't really care about annuities or annuity basics. Bear with me for just a minute, because if I give these basics to you, you will be armed, you will be prepared, and then the rest of what I'm going to tell you today, it will make a lot more sense. And I fear that a lot of the annuities that are sold, that the agents selling them don't even understand what I'm about to tell you. All they're told by their company is, here's your commission, go sell these things. And most of the agents are not truly independent. You know, I always wonder why when clients come in, there's always like this handful of companies. And, you know, I always wondered, why are these the companies that are selling the most annuities over everybody else? Can you guess why? My skeptical side says the agent was not a financial planner. The agent was a commissioned agent. And all they did was they said, this one pays 5% commission, this one pays 6%, and this one pays 7%. Which one am I going to sell? 7% is what the agent thinks. Versus the financial planner that's looking at it and saying, maybe we need to diversify between some different companies. Maybe we shouldn't put too much with one company. Maybe we should have different indexes available. And maybe, you know, there's a portfolio of 5 or 10 or 15 companies that we should use. Versus what I normally see, there's about 5 companies that I see all the time when new clients come to us. And again, my skeptical side says it's probably because of the commission. So policy date, what is that? That's the date that they issue the policy. Why is that important to you? Because it is the date that they demark the index that you are investing in. Now, let me be clear. An index, what is an index? It could be like the Dow Jones Industrial Average is an index, the Russell 1000, Russell 2000, the S&P 500, the FTSE, whatever it might be. An index is just a collection, like the Dow Jones is a collection of 30 stocks. When you add up the prices of those 30 stocks, you get a Dow Jones Industrial Average today of 22,000 and some change, right? That's how the index works. So if you base it upon 30 stocks, or the S&P 500 at 500 stocks, or the Russell 1000 at 1,000 stocks, it's just a basket of those stocks. That's all an index is. These equity index annuities will give you a menu. It could be 2, 3, some of them have 15 different indexes. You can have maybe the option of putting into all 15 indexes to get a fully diversified portfolio, or you might be relegated to maybe 1, 2, or 3. Depends on the annuity, the company, the contract. And sometimes people will say, well, you know, this contract was done this way in 2010. Well, these insurance companies will change the indexes available every single year. They will either add or they will subtract what you can and can't put into. So an index, you must choose either one or a multiple amount of indexes, like an asset allocation, like a diversified portfolio, to divide the amount of money that you put into the annuity into those indexes. So here's the example, an S&P 500 index. As an example, if you would have bought your annuity on March 27th of 2019, the S&P 500 was at a level of $2,805. Today, when I wrote this in the afternoon, it was at about $2,500. So from a year ago, the S&P 500 is down 300 points. So what does that mean? If your policy date was March 27th, 2019, you would have no returns for the year, because the returns are calculated on one single day. So the S&P 500, if your policy date was February 20th, 2019, your start was 2774, and your end was on February 20th, 2020 or 2020. The S&P was at 3,370, or an 18% increase. So that one day does in fact make a difference. That's what's called your index calculation date. A cap. What is a cap? No, it's not that thing you put on your head. A cap is what the insurance company will put a maximum amount that you can earn. So here's the example. Let's say that you had a cap of 7%, and let's say you use that 18% rate of return. Well, even though the S&P 500 made 18%, You can only make 7. That's your trade-off compared to the prior example. So the other example is, let's say the S&P 500, you bought it on March 27th, 2019, 805, today it's about 2,500. Well, you wouldn't have lost anything in the principal value of the annuity. However, you wouldn't have made anything in an up year either. So the trade-off is you don't get to participate in the full upside of the market. The insurance company is going to institute a cap. That is the maximum amount that you can earn. So example, if you had a cap of 7% and let's say the stock market made 5%, then you earn 5%. However, the insurance company will also institute something called a par rate or participation rate. This is the amount of the index that you get to participate in. So here's the example. If your par rate is 50% and your annual return is 18%, you get to participate into 9% of the market's returns. It's a 50% participation rate. Now, if your cap is 7, even though the participation rate is 9, you get 7% because that is your cap. If your cap is 50% and your annual point-to-point is 5.5%, then you make 2.5. That's your max, right? It's either the par rate or the cap rate. Let's go on with the old annuities. There was a major change in the annuity markets. For many years, I used annuities in an asset allocation design, in an investment design, and I even had them in my own design. And in 2017, I got rid of all of my annuities for the purposes that you're about to see. Yes, I did my own cost benefit analysis. I ended up paying the surrender fees at that time because after I ran the cost benefit analysis, I understood that what the insurance company has changed would render my ability to make money useless. So I'll show you what happened. In 2007, annuities had caps of 7%. On my annuities, I was making 6, 7, 8, 9% per year because my caps were super high. And in 2017, a new mortality table was released. Mortality table was the percent of Americans that die per year. And it was stating that the average American was living a little bit more than 2 years for the average American. Well, there is a collection of actuaries and they develop what's called the Commissioner's Standard Ordinary Table. And these actuaries are generally employed by the insurance companies. So each insurance company might employ a number of different actuaries and they collect all their data together. And each state has to approve this new mortality table. Well, here's the big change. In 2017, when they created the new CSO, it had not been changed, ready for this one, since 2001. Let me give you a little context into this. People had come to us for many years, and it's the opposite of an annuity than it is with life insurance. So people would come in with life insurance that they had bought in the 70s. And let's say you had come into my office in 2010. So in 2010, you were paying the rate of insurance based upon something you bought in the 70s. So in the 70s, the death rate was much higher. Mortality was much less in the 70s than it was in the mid-2000s. The main reason for that was the computer chip drastically increased our science, our technology, which then increased how much longer we're living. Now, some people would argue, yeah, I know we're living longer, but we're living in nursing homes. We don't know who we are, unfortunately. And so there's not really a greater quality of life, but people are living longer. So what that did was for life insurance, if you had bought that in the 70s or the 80s, you might have been paying 30, 40, 50% more per thousand of insurance than you would have after 2001. And again, in 2017, they changed the insurance rates. So if you would have bought something in 2010, you were paying the mortality based upon 2001. However, it works just the opposite with annuities. With life insurance, since you're living longer, it costs you less money. With annuities, because they have to give you some guarantees for life, now your guarantees will get less because they have to promise it for a longer period of time. So 2017 was a very critical year. Now, unfortunately, they started this CSO table in 2015, and some of the companies started adopting this early. So we saw this major change as early as 2016. But in 2017, all of the insurance companies adopted this new mortality table. What did that do to anybody that had an annuity? Well, the longer life expectancy required more reserves. Results that insurance companies, in order to, in their opinion, allegedly, in order to guarantee that money would be around longer, what did they have to do to adjust for it? They had to lower the caps. So average caps went from, what, in my opinion, what I've seen across the board is they went from 7% down to 2.5%. So again, let's look at the impact of a cap. Market goes up by 18%. You have a cap of 2.5%. The maximum that you can earn now is 2.5%. Let me pull that back up on the screen so that you can see it. It's 2.5%. So now let's go into this whole guaranteed income that an annuity promises. Now, let's contrast this prior to 2017 and then after 2017. And then I'm going to finish it up by showing you how it fits into the stock market today and what you can do with these things. So what an income rider is, and you might see these commercials all over TV today. Get guaranteed income, income for life, whatever they're calling it, but they're saying don't ever run out of money. Well, there's always a price with that. And prior to 2017, I would admit these things were a really good deal. I mean, here's how it would work. You could make 7 or 8% per year, have no market risk, and they'd guarantee you a 5% payout per year. Not a 5% guaranteed rate of return, but a 5% payout. There's difference. If you have an IRA and you have a 5% required minimum distribution, you could have made 0 on that IRA. You still got to pay out 5%. And the 5% you paid out, if you made 0, is, guess what? Your own 5%. So again, it's no different with an annuity. If the annuity company says, we're going to give you 5% income per year, that doesn't mean you're making 5%. It means they're just giving you 5% out. So prior to 2017, when a person could earn 7%, it wasn't a bad deal. You get 5%, you make 7, the account goes up by 2. However, in 2017, now that they lower the caps down to the average, what I've seen of 2.5%, the game changes. So let me show you what happens. So what an income rider is, it's an amount that they're going to guarantee to pay you every year. Even if your account goes to 0, they're going to continue this income. Now, I know that this has been one thing people have come in and they've said, yeah, but I don't care if my account goes to 0 as long as I get the income. You may not know me, but I will tell you, after almost 36 years, don't ever give up your principal. It's never a good idea. What I'm saying is that there are going to be times in your life where you may not know that you need a lump sum. If your annuity goes to 0 and they're still paying you an income, that's great. As long as you never have a health catastrophe, you never need to go in a nursing home, you don't need continued care, no family member needs money. However, as a financial planner, that my main goal is to try to help people hold on to their money and sleep better at night. It just doesn't go well under the new conditions. Let me show you why. So how it works, a $100,000 annuity investment with a 5% guaranteed rider. Typically, these companies will have a 1% fee that comes along with that rider. Now, on $100,000, they're going to give you $5,000 per year. So in the reality is this, in year one, if I have $100,000 with a cap of 2.5%, and let's say that it earns $2,500. So it doesn't matter what the market does, I can earn $2,500 because that's what the cap is. But the rider is going to pay me out $5,000. So the rider gives me $5,000, but I've only made 2.5, So what's going to happen? You got it. I'm going to go backwards because they're giving me $5,000, but I've only made 2,500. So where's the other 2,500 come from? My own account. It's not magic. They're not guaranteeing me a 5% annual income, which would be absolutely ridiculous, right? Can you get that in a 30-year government bond, maybe with some collection of diversification today? Some corporate bonds, probably. But the key is that the annuities are not promising a 5% rate of return. It's just 5% of your own money coming back out. So let's go into year 2. Now I've lost $2,500, right? Because I also had an annual fee that I had to pay on that annuity, on the rider. So now I'm down to $96,500 into the second year. My cap is $2,500, 2.5%. Now we're making the presumption here that the market goes up. Well, the market doesn't go up every year. If we used an average market that goes up every 2 out of 3 years, or 66%, even if the cap is 2.5%, let's do the numbers. Let's say the market goes up year 1 by 10. Great, I make 2.5%. Let's say year 2, the market goes up by 10. Great, I make 2.5%. How much have I made so far? 5%. Next year, market goes up, market goes down. My annuity earns goose eggs. So I've made 5% over 3 years. It's not a guaranteed 2.5% rate of return. That's the maximum that you can make. So now I've made 5% over 3 years. So what is that? 1.7, 1.75%, somewhere around that area. And so I'm not making 2.5%. So in this example, I'm not telling you you're going to make 2.5% per year. It'd probably be less. I'm just saying that's the maximum amount. So I'm looking at best case scenario. Okay. And again, this is where we are after 2017. So now what happens is I have a loss of $3,500 from my principal. So again, I'm going into the next year only with $96,500 because my cap is 2.5%. Now the next year, my rider says it's going to pay me out $5,000. However, I'm still going to have a rider fee. It's reduced to $965, but now I have a loss against my principal of $3,553. So what don't I like about annuities? Number one, today, they're low caps. Number two, you have a 1-day market time to calculate your rate of return. Now, that's market timing, because what happens if your anniversary date happened to be February 20th of last year? Well, you would have made 18%. What would happen if your policy date was March 24th of last year? You'd have made nothing. So one single day. So again, going back to the prior annuities where we could make 7 or 8%, great deal, right? Because I can average it out. If you do those numbers again, say your cap was 7%, and year 1 you make 7, year 2 you make 7, year 3 you make 0. So now I'm averaging about 4.5% average per year at no risk. Prior to 2017, that was a great deal because bonds were paying about the same, but I had no market risk within the annuity. Today, with the caps being lowered, whole different ballgame. So income, what I don't like now is I have income riders because they've lowered the caps that can eat into the principal. Also, here's another big issue that a lot of people don't know about. They buy these annuities, and the agents that don't understand how to write them will put joint, they'll put single, they'll sell somebody a single annuity, and they'll tell them that the income rider lasts for both husband and wife. However, not every contract works like that. Some people can buy a single annuity, and it might be inside of an IRA because you can't buy an annuity jointly. And some companies allow a transference of the rider. Some companies reset it. So if you now transfer and you put $100,000 in, but the principal's only $50,000, the spouse is going to be left high and dry because they don't have the same amount of principal. If the principal is 0, depending upon the situation and the contract and the company, the spouse could be left with nothing. Again, don't like the idea that it can go to 0 now with these low caps. Okay. I also don't like agents that aren't telling people all the details. I have people coming to me now and saying, well, the agent tells me there's not a single fee and you don't have to pay a single thing and you're not paying me. Well, you're paying the agent. You're just paying them indirectly. And indirectly means that the company is forwarding them the commission, but how they earn that commission is by the surrender fees so that the insurance company has it long enough. You hold that annuity for a long enough period of time, and no, you are not paying a commission. However, if you have the rider, there's still a fee. So you have to understand, nothing is for free. The agent is getting paid. It's just how is he getting paid? Is it fair? So this is what I hear a lot of times. There's no fees. Well, there are fees, and there's no risk. There is risk because if I put all my money into an annuity right now and I have a cap of 2.5%, and let's say in 2 years from now, the market returns 20% per year, well, I have a huge risk. I just lost out on 30-40% potential rate of return. Now, let's say I have a risk of inflation. Let's say that the cap is 2.5%, but on average, it's going to make 1.75%, but inflation averages 2.5%. Let's say that the annuity is written wrong, and when I die, my spouse doesn't get to continue the income at the same rate as what I was getting, and she has to take a reduction in income. It's a risk. Let's say that the insurance company folds and that state doesn't have enough insurance coverage to cover the amount that I have in the annuity. I take a risk. So let's be real. There's risk with everything. It's just what kind of risk is it, and is it acceptable to you? So how and when do we really use an annuity? Do I believe that there is a place for annuities today after 2017? I do, but it's in a unique situation. Here's what would it be? Let's say somebody already had an annuity, and let's say that there was a built-in taxable gain, and that annuity was either expiring or they've lowered the caps or whatever it is. Well, we have to measure, if you cash out of that annuity, do you pay a giant tax on it? Or if you convert it, can you convert it without tax, called a 1035 exchange? You can exchange them without tax. And then can you find something that has better caps, better terms, better indexes? Okay, so that might be a useful application. What else is a useful application? If you do a financial plan, and I'm not talking about these insurance agents that call themselves financial advisors and they put together a collection of annuities and call it a financial plan. I'm talking about a true bucket distribution strategy where the annuity plays the part of a short-term bond, and depending upon the annuity contract, it could play the part of an intermediate bond as a part of a fully diversified investment portfolio. But I have people come to me and they'll show me these proposals, and the financial advisor wants them to put $1 million into 3 different annuities. That is not a financial plan. That is a free trip to the Bahamas and a free car payment for the insurance agent. But it's not a fully diversified financial plan. So I find today, after 2017, there is very limited application for these equity indexed annuities, very limited. So prior to 2018, the only options were standard annuity contracts. They increased the surrender period and the penalties, but after 2018, so this was a result of this CSO change, the reduction in caps. There were a couple companies that actually came out, and what they did is they eliminated any kind of agent compensation, which is great because this way we as a fiduciary can, there's no commission that we're earning, but the advantage is you take the commission out of the calculation, and now these companies can offer a much higher cap, shorter surrender periods, smaller surrender fees, okay, because there's actually no commission paid out of them. Now, in 2018, these products were developed for just this reason: increased caps, decreased surrender penalties and fees. Now, what if you have an older annuity? I think I covered a little bit of this, but I'll touch on this. You have to do a cost-benefit analysis. Don't just say, I've got annuity A, and this guy is proposing annuity B, and it looks so much better. No, there's so much more that goes into that math and that calculation. There's tax, there's surrender fees, there's break-even periods of time. What does the new contract say versus what the old contract says? So there's a lot that should go into that, and that's why I do not believe any person should buy something from an insurance agent selling these things. Why? Look, I'm not beating these guys up, but the bottom line is, if I go to a Mercedes dealership, they're going to sell me a Mercedes. If I go to a General Motors or a Chevy dealership, they're going to sell me a Chevy. If I ask the Chevy dealer, what does he think about Ford? What do you think he's going to tell me? It's the same thing as if I ask an insurance agent, do I need insurance? Of course you do. If I ask an annuity salesperson, do you think I should buy an annuity? Well, of course I do. That's why I always believe somebody should go to an independent person, pay a fee for an independent analysis, let them give you some independent advice versus taking it from the person that's selling it, okay? So number one is determine whether you should pay a surrender fee. What is the taxes? Does the new product have a higher cap, or should you just get out of the annuity altogether? That was my decision. I decided that because I wanted to deploy that into other areas. So I did a cost-benefit analysis of, if I pay the surrender fee, what is the cost, what is the break-even period of time versus the rate of return that I can earn on something else? I was very happy I did that. You have to figure out how much you can access in the new account if you're going to roll it over to another annuity, or how much could you make in other alternatives? Could you buy a business now that we're in this giant crash and people are going to be selling businesses at discounts? Should you buy stocks at discounts? Should you buy bonds that could potentially have a higher rate of return without all the complication? Should you buy real estate? I mean, you read anything about me? I love real estate. I just don't like being a landlord, but I love real estate because I can calculate an absolute number versus in stocks, I can calculate intrinsic value, and I would much rather buy a stock than real estate and be a landlord. But the problem is I got to be very careful and not try to locate one single stock. I've got to do it in a portfolio of ETFs. So I like real estate. If you keep your annuity, find a financial planner, fiduciary planner, that not just an insurance agent. Create an asset allocation model. So if you have an annuity, or if you're going to buy one of these no commission deals, there are indexes that every fixed annuity allows. There's a multitude of indexes. And the mistake that a lot of people make is they buy an annuity and they expect that either the financial planner or the insurance agent is going to manage those indexes. They're not getting paid to do that. You have to be willing to go out and find somebody and be willing to pay them on an annual basis, review all the indexes that are available, and then figure out what percentage into each index. Because what happens is every insurance company might have anywhere between 3 to 15 indexes, and there's different moving parts. And they sometimes take indexes out one year and replace it with another year. So unless you are capable of doing this on your own, you should find somebody that understands these indexes and can manage them to get you out of one index into another index. If you're not willing to pay somebody, then it's up to you to make sure that you're following those indexes. So let me wrap up, and I'm going to tell you a little bit more about what's going on with the Secure Act and some of the things that you can do with the annuities. So I am highly recommending to everybody that they take ambitious, aggressive action to try to figure out where can they access cash from. Can they take it from, most annuities give you a 10% free withdrawal on an annual basis. You can take the money out. You have to be very careful of taxes. If it's in an IRA, you can take it out as long as it goes to another IRA. If it's in a non-IRA, you have to be very careful if you take that money out that it's not taxable. If it is taxable, your financial planner might be able to use an offset. Like what we've trained our financial planners to do is that when they recognize that there's an opportunity, but they have to take something out of one area and it causes a taxable event, we use what's called tax offsetting. What can you create as an offset to knock that tax out so that person can get the money out with minimal amount of taxation? So try to find and put your hands on as much capital as you can and redeploy it. If you like real estate, get ready. In 6 to 9 months, you're going to see some just whopper of deals that you can invest in. If you like stock, my gosh, there's just so many opportunities. I can't even count them. I've got a list now that I'm researching of almost 100 different stocks. And so there's no shortage. You know, what they said was after the 1920s, the roaring 20s where everybody was just go, 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 there wasn't a lot of opportunities. And when the crash happened, those people that understand that you don't overpay for something, that's where they made their money. This is no different. There are tons of opportunities out there. All right, with that in mind, I want to direct you to your screen, and you can also now go to hhrdm.com and events. You can find the other upcoming events that we have. You can also keep tuned to these events that I'm doing, especially the live events, because we're talking about the stimulus package. Okay, I promised at the end I would cover some of the Secure Act and some of the IRA changes. Okay, so here's the catch. 2 days ago, when the House passed, or the House submitted their plan for the stimulus package, one of the things in that stimulus package is the deferral of your 2020 required minimum distributions. Here's what's interesting. When I came out, I think it was on today's Friday, Wednesday, I said to everybody, I just learned about this last night. I've not had a chance to study this. There's so much going on right now. You know, I don't think I'd worked this much since I was 20 years old, but I have not seen this much information to absorb and this many opportunities to analyze. So I read that Stimulus Act late that night. And it's interesting that Congress said, well, what we're going to do is we're going to allow people to defer their required minimum distributions. And actually on Fox News the next day, I think it was a guy from Tennessee, Kentucky, it's all mixing together now. Anyway, one of the congressmen got on and said, well, we wanted to pass this, you ready for this? So that people wouldn't have to sell their stock to distribute their required minimum distributions. Now, either this congressman is so smart and he understands how wrong that is, or he just doesn't know any different. I don't know. But here's the bottom line. If I got $1 million in an IRA and I got a $50,000 RMD due in 2020, now here's a little note. They did put an exemption that if you've already done your RMD, you can't undo it. You gotta take it. However, if you are, let's say you've got an RMD and you've got $1 million in your account, you want to distribute $50,000, and that is your RMD caught 5%. Let's say what we do and what we're doing right now is for every client, we are calculating every single IRA for what we call a discounted tax RMD. So here's how it works. Let's say you had $100,000 in stock in your IRA. And let's say now that stock, because of the $75,000. Oh, let's do another. Make the math easier on Ken. So let's say it was a $75,000 stock, and because of the push down, it's worth $50,000 now. My example was you got $1 million in an IRA, you got to take out $50,000 in an RMD. So you got $75,000 that you bought in stock, and now it's only worth $50,000. What would we do for you if you're a client of ours? We're going to take the shares of that stock. This congressman said we don't want people selling stock. You don't have to. You're allowed to meet your required minimum distribution by taking the stock shares and transferring them to your non-qualified, meaning your non-IRA account. You don't have to sell the shares. You can meet that RMD. So if you were listening to me on Wednesday, I said, please hold, don't do anything. I put my entire team on hold because I didn't want them to process any more RMDs until we figure this out. On yesterday, I came out and said, I've come to a final decision. I think everybody should do their RMDs this year. Do not defer them. However, what you can do is now you can convert. See, the normal rule was that you are not allowed to use your RMD to convert to a Roth. You have to meet your RMD first. So let's say that, as an example, we use my $1 million in my IRA. I got to make a $50,000 RMD, and I cannot convert any of that $50,000 to a Roth. So if I wanted to convert to a Roth, I have to take out more and pay tax on that difference, right? I'm going to do $25,000 in a Roth. Then I got to take my 50 in RMDs, got to pay tax on that, and I got to take another $25,000, pay tax on that. However, here's what's golden this year. Right now, instead of taking and deferring your RMD, take it this year. Take that $75,000 of stock that's worth $50,000 now, take the shares and convert them into a Roth. That was not allowed. And it's interesting because we actually tried to do it with one of our custodians. And the custodian wrote back today to one of our financial planners and said, well, we can't convert to the Roth because this client hasn't met their RMDs. So we had to instruct them, well, sorry, but there are no RMDs in 2020. So there's no requirement to meet an RMD in. So this is our categorical recommendation that everybody, and of course, do the math. If you're not a client of ours, if you're a client of ours, we're doing the math for you. If you're not a client of ours, do the math to figure out the optimal amount, because you might want to do more than just what your RMDs would have been, okay? Now, with that in mind, I'm going to open it up to some questions because we're just about 4 minutes over right now, and I'll give a few minutes to some questions. So let's see what we have here. And if you're not familiar with this, top left of your screen, you can see a little Q&A button, and you can pop your question in right there. Okay, so let me go through some of these questions for you. Well, this is a pretty good question. And, I don't know. I mean, we're going to probably have to go through some real arguments with the custodians. And here's a question. What if my custodian doesn't recognize that you're right. I think a lot of these systems that the custodians have set up might actually not allow you to do it. So we're going to test it. We're going to test it with Schwab and Interactive Brokers and TD Ameritrade. We're going to see if them putting this 2020 RMD on hold will still allow us to convert to a Roth. However, I think I have a workaround. And that workaround is if they don't let us do it, what we can do is just take a withdrawal from the IRA, move it into a non-qualified account, and then move it into a Roth. Now, I know what's going to happen. The custodians will probably code that as a withdrawal. But on the tax returns, we can prove that we rolled that in within the 60 days into the Roth, okay? Now, again, we're in uncharted territory today, so we kind of got to figure out what these workarounds are for this year, okay? Well, so this question, so let me explain something. This question asks a specific recommendation. I cannot make a specific recommendation. The things I'm giving you are opinions. This is what we have a financial planning team for. You come in, you bring your data in, we do financial calculations, and then we can make individualized recommendations based upon your specific situation. And even those people that email me after the shows and ask specific things, if you're a client of ours, that's what your financial planner is actually calculating for you. And if you're not a client of ours, I apologize. I can only answer generalities as the direction and the concepts of what I think people should be doing right now. But if I don't have that financial data, that would be like going to your doctor and saying, hey, doc, I got a pain in my side. Give me a prescription. And the doctor says, well, I got to do a bunch of tests to figure out, make sure I don't give you something that kills you. And you say, well, no, just tell me what prescription I need. Well, it doesn't work like that. Same thing with money. You can't just make that kind of prescription without doing the calculations and tests so that the prescription doesn't hurt you. Okay, so hopefully that helps you. I apologize, I couldn't give you the answer to that question, on that real estate specific question. Let me go to the next question here. I'll tell you what I'll do is it's 7 after. I'll take one. This will be the last question, and then I've got a listing here of everybody else. What I'll do is I'll email you out the general questions as long as they're not specifically investment related. Okay, the next question is Roth conversions. I'll tell you what, I'm going to jump over that question. If you go to our blog, hhrdm.com blog, or you go to our YouTube page, you can actually find an entire webinar and live stream that I did on the Roth conversions. And let's see, help me out here. I believe that was, actually, I think that was yesterday. It was on tax survival under coronavirus. Okay, make 30 seconds. I'll answer this last one real quick here. Let me just look here. Well, that's an interesting question. What is my best guess as when the best time to buy into the stock market is? And I will tell you that there is no best time. I think that the best thing that you can do right now is you can hedge it. Hedge it means that you're going to buy in over time. You're going to buy either 1/12 over the next 12 months. You're going to buy 1/24 over the next 24 months. You're going to buy 1/4 over the next quarter or 1/8 over the next 2 years. You have to determine, if you're not working with somebody, you have to determine what you feel that economic mapping is going to look like. As you find different events and different things happening within the economy, global political issues, economies, macro, microeconomics, you're going to have to adjust that economic mapping so that you can better adjust. Okay, so that will be my last question. And again, thank you for joining me tonight. And hopefully you can join me tomorrow morning. And we're going to talk about the lessons from 1929 crash and what you can do to take advantage of some of those ideas today. All right, signing off. Have a great night.